Let's review what's going on in the stock market and why things are getting shakier and shakier. And as always, you know our research is coming straight from MacroOps, which is our global macro research and consulting firm. If you're not on our email list over there, you should be. But if you take a look at small caps right now, which for us, we track the Russell 2000 index, RTY, they're knocking on the lower bound of their 7-month range while breadth keeps deteriorating. So these same small caps saw a failed volatility breakout last week, and they reversed off their key support along their 7-month trading range, because right now, as you can see right here, we've been trading sideways for a long time. And this little green bar right here was the reversal. And this is to be expected because about 80% of breakouts from trading ranges fail to both ways. So if it was breaking higher, there's a good chance of it failing. If it's breaking lower, same thing. So betting on mean reversion is actually a good play a lot of the times. And markets only do two things, right? They either trend or they mean revert. So you can make money in either of those regimes depending on your strategy. So odds favor a bounce over the next few days. However, as we said, breadth is weakening. And the more times that a support or resistance line is tested, the more likely it is to fail. So you can see how many times this bottom has been tested, right? 1, 2, 3, 4, this is the 5th. So it's survived, but if we keep going like this, eventually it's going to break. And you can see it only hit the top of the range 3 times. So that's something to keep in mind as we see small caps continue to play out. And our team is ready to get short if it breaks below this green level. And now I realize I should have expanded this because it's much easier to see. But here's the green level, here's the bounce. Watch for this to break. Because like we said, the more time it hits this, the more likely it's going to happen. Total new 52-week lows of all US stocks are starting to spike again. And this is the first time it's happened, which you can see right here, these little red lines. It's the first time it happened since the March COVID lows. So that's another sign of growing trend exhaustion. And while this is happening, large speculative positioning in the S&P remains elevated in the 83rd percentile as we enter one of the weakest periods of seasonality. So people are very long. And remember, when too many people are long, that's actually bad for the stock market because everyone is too positive. They have all their money invested. What you rather have is a market moving higher with a lot of people bearish because there's a lot of people left to convert and buy and then push prices even higher. And we'll talk about that more in a second. Another thing we track is our nervous and numb indicator, which looks at the technical relationship between the S&P and the VIX. And the VIX is the volatility index. So it's useful for identifying both buy and sell zones on both daily and weekly basis. So right here, you can see the indicator on the weekly. Now, of course, this indicator doesn't have a 100% hit rate, but it can give you some context. And as you can see here, it just triggered a sell signal on the weekly time frame. You see all these red highlights where it hits this level, you do see a pretty significant sell-off. So these vertical red lines are the same signal over the last 3 years. And this kind of jives with the other late trend conditions that we're seeing develop. And remember what our thesis is here, that buy climax. We're expecting markets to kind of shoot up and then fall, get that 10 to 20% correction, and then go sideways for a while. Basically digest all the gains that we've had since the COVID lows. Another thing that we always look at is the semiconductor index, right? Because it kind of leads the market. And of course, the factor that we've been looking at is breadth in particular. And you can see it's actually breaking down. And now it's at its lowest levels once again since that COVID bottom. So the breadth is no longer confirming the trend up in semis. And the breadth is based off the percentage of semiconductors trading above their 200-day moving average. And again, in a strong market, you want all the stocks moving together instead of just a few stocks propping the market up and driving it higher, because in that case, the price will probably follow where the majority of the stocks are going. So you really want breadth and price moving together. Now, if you've been watching our videos, then you know that for the last 2 months, we've been playing the final leg of this up move in equities. But this whole time, there's been consistent high trend fragility, which is the same thing we've been talking about with this breadth and everything. There's been crowded positioning and overly bullish sentiment as well, which goes back to what we were just saying a minute ago with 80% or something of speculative longs. But despite these weak internals, the main indices have trudged on to new highs. But when you look under the hood, things keep deteriorating. So it's been crazy, kind of. So they've withstood the diverging credit and weakening breadth. And we already talked about breadth, but in the previous videos, we talked about credit markets too, because they lead equity markets and they weren't looking so good. So basically, markets have been shrugging off what's historically been a very reliable confluence of bearish signals. This back and forth of market internals is some of the choppiest we've ever seen. And that's why in the MacroOps portfolio, we've been sitting on roughly 50% net cash for the last 2 months. Now, this is more than we usually carry and we would deploy it, but the data is very noisy. Now, another concept we've talked about before is how we're transitioning from a recovery, which is what we've been in, to what will likely be a back and forth rotation between slowdown and expansionary regimes. So in each regime, assets perform a certain way. And this is partly why we're seeing such a crazy environment. The market market is trying to figure out what's next. So we're kind of at a turning point right now. And then, of course, we have the spread of the Delta variant and its impact on the less vaccinated regions in the world. And on top of that, we're transitioning to the backside of major credit impulses. So if you remember way back, maybe a year or so ago, we were talking about China's credit impulse, right? Because they're a big driver of markets around the world. So when they start pushing money into the system, you see asset prices everywhere go up. Well, that's winding down a little bit. This picture right here, global credit impulse, we're on that tail end. So that is going to have an effect on markets as well. So markets always swing from times of feast to famine. The COVID lows to spring this year, they were a great time for easy returns, but ever since, picking these trends has been harder. Now this is natural, of course, because it moves in cycles, so this famine is setting the stage for the next feast. But for that to happen, we got to see the expectations and positioning reset, which is why we're always tracking this every week. And remember our current thesis, right? We're tracking the buy climax, where the markets accelerate into a 2 to 3 week parabolic run up, which is the final one, and then we see the turning point. But this one has been a little weird because of these market internals that we're talking about. So breadth has really been all over the place, which is why it seems weird, like we're wishy-washy every week, but that's literally what's just happening in the market. So breadth will look bad and then it'll reverse and actually look good and then reverse again and look bad, which is not usually how these things play out. But the longer that breadth and credit, which again we've been tracking, fail to rebound and hold those levels of strength that it needs, then the heavier the broader indices will trade. So that will be more and more bearish. And the greater the gravitational pull becomes for them to catch down to their weaker performing holdings. Meaning the stocks that are pulling the market higher right now, eventually they're going to fall in line with the rest of the stocks because breadth is so bad, and they'll all perform poorly together. So you can look at the Nasdaq right here, how breadth is looking, it's trending lower. So the longer it fails to rebound and hold, the tougher it becomes for this index to stay elevated, and the more likelihood that we see that downside. So Sentiment Trader shared a study recently showing how many times before there was such a divergence between the Nasdaq's price and its breadth. This is incredibly rare, as we've been saying. So if you look over here, there's only been 2 other instances of this happening over the last 25 years, which are these red dots here. And on top of this divergence, Wall Street is just super bullish the whole time. According to Bloomberg, 56% of all recommendations on the S&P 500 firms are listed as buys, the most since 2002. So euphoria is sweeping the markets a bit. And this is really a group you want to take the opposite position of because their groupthink has a habit of being strongest just before the market turns, which is kind of what we're seeing now. So Bank of America's latest global fund manager survey kind of explains it more. So fund manager expectations have rolled over from exuberant levels, but their positioning is still majorly bullish because of TINA, which is there is no alternative. But data does show that their positioning, so where they're putting money, has a history of lagging their better judgment. Why? Because fund managers have to chase returns, right? So if you have a period where you pull your money out and no one else does and they get those last few percentages of return, you're not going to look so good. Even if you end up saving more at the end, there's certain benchmarks that you got to meet in certain quarters, right? So it's another stupid game that managers have to play, which is why you see money flood out of some of the best managers' funds when they have, say, a year of underperformance, because the fund manager wants to look at things over a 5 and 10 year time frame. Investors, though, they're looking like next week. How you doing? It's stupid. But none of the public really understands markets, so what are you going to do? Even really smart people don't understand markets. And if you do understand them, it's another thing to have the patience to deal with them. This stuff isn't easy. And the millions of Robinhood accounts that came into the market during this whole pandemic, they are going to learn that sooner or later. So definitely keep an eye on this market because it is shaky. Do not forget about your risk control. As I'm recording this right now, the Nasdaq is having a real good day. But again, internals are shaky. So we might get that buy climax, but we might also not get it and we might get the correction before. You can't really know, which is why you need that risk control in place. And there's actually a great quote that Alex published today. The most powerful word in the markets is despite. If you hear or see a comment like, despite the increase in oil inventories being much higher than expected, oil prices closed higher. Well, that's the tape telling you what's going to happen. Everyone saw inventories were much higher than expected, so why did markets close up? Well, the tape knows more than anyone else. And this is from Jason Shapiro in Schwager's Unknown Market Wizards. So at the end of the day, price is very important to follow, but again, following price with your risk control in place, because you're only ever going to know maybe 60% of what's going on in the market. That's just how it is. And if you haven't checked out our automated system that does exactly that, follow price while having major risk control in place, then make sure you check out our free training right here. We teach you exactly how the strategy works and how you can use it yourself. So there's going to be a link to this page in this video and down below in the description and comments. Definitely check it out if you haven't already because it will make your life much, much easier. Again, the link is right here. Click it and I will see you inside the training.